Silver is at $84 today. Let that number sink in for a second. $84. Because 1 week ago, the people who run this system, the people who write the rules in the middle of the night, the people who have every algorithmic advantage that money can buy, those people looked at the silver market and decided they needed to kill it. Not slow it down, not cool it off, kill it permanently. They wanted to end the silver bull market right there on February 4th, and they used every single weapon in their arsenal to do it. And they failed. That is what this video is about. Not just the crash, not just the recovery. This video is about the smoking gun. This video is about the moment you can point to the exact timestamp, the exact mechanism, the exact dollar figure and say, this was not a market, this was an operation, and it failed. And the fact that it failed is the most important financial story of this decade, and Bloomberg hasn't said a word about it. CNBC is talking about tech stocks, and the financial media complex is completely, utterly silent. So you came here, and I am going to give you everything. February 11th, 2026. Silver is at $84. The vault in Shanghai is essentially empty, and the banking system is sitting on a short position so large, so catastrophically underwater, that they had to change the rules of the exchange itself just to survive the week. I want you to understand something before we go any further. I want you to understand the scale of what happened, because when I say they changed the rules, I don't mean they tweaked a policy document somewhere. I mean that the CME group, the Chicago Mercantile Exchange, the most powerful futures exchange on the planet, raised margin requirements on silver contracts by $3,000 per contract overnight, while you were sleeping, without a press release, without a public hearing, without a vote. $3,000 per contract. Now let me do the math live, right here, right now, because this is where the crime scene starts to take shape. At the time of that margin hike, there were approximately 225,000 open contracts on the COMEX silver futures market. 225,000 contracts. Multiply 225,000 by $3,000, you do not need a calculator. 225,000 times 3,000 is $675 million. $675 million was drained from the silver market in a single night. Not sold, not redistributed, drained, extracted. Pulled out of the hands of long position holders who did not have an extra $3,000 per contract sitting in their brokerage account at 2 in the morning. And when you can't meet a margin call, you know what happens? You don't get a phone call. You don't get a grace period. The system liquidates your position automatically. The algo executes the sell order, and the price collapses. That is how silver went from $120 to $64, not because someone decided silver was overvalued, not because of some fundamental change in industrial demand, not because of a surprise Fed announcement or a geopolitical de-escalation. Silver dropped $56 because the exchange changed the rules overnight to force liquidations that would save the banks that were short. If you saw that price drop and thought it was a market, you were looking at a crime scene. You were watching a financial assassination attempt, and now it's $84. The assassination failed. Now, let me back up, because I know some of you are newer to this, and I want to make sure you understand not just what happened, but why it happened, and why it has happened before, and why the people doing it thought they could get away with it again. Because this is not the first time, this is not even the 5th time. The CME has raised silver margins in emergency fashion at least 6 times in modern market history, and every single time the purpose was the same: protect the short sellers, crush the longs, and buy time for the banks. Let me take you back to May of 2011. Silver was approaching $50 an ounce, a multi-decade high at the time. The commercial banks, specifically JP Morgan, which had inherited a massive silver short position from Bear Stearns after the 2008 collapse, were sitting on losses that were becoming existential. The CFTC, which is supposed to regulate these markets, was completely captured, and so in the span of roughly 2 weeks, the CME raised silver margin requirements 5 separate times in rapid succession. 5 times. Each hike forced more liquidations. Each liquidation drove the price lower. Silver went from $49 to $32 in a matter of weeks. The narrative in the financial press: silver was in a bubble, the bulls got greedy, it was a natural correction. It was not a natural correction. It was engineered. And the same machinery was deployed again last week. But something different happened this time. Something that should make every single person watching this video pay extremely close attention. The price came back. In 2011, after the margin hikes, silver took 3 years to get back above $30. 3 years. This time, the price recovered from $64 back to $82, $83, $84 in a matter of days. The suppression lasted days, not years. And that tells you everything you need to know about the supply and demand fundamentals that are operating underneath this market right now. The dam is cracking, and no amount of paper selling can hold it. But before we get to the Shanghai data, and the Shanghai data is going to melt your brain, I need you to understand the full anatomy of this margin hike, because the CME did not do this in a vacuum. The CME did not decide on its own, on a random Tuesday night, to extract $675 million from the market. That decision was made in coordination with the banks that needed the relief. And here is how I know that. Look at the timing, not the day, the hour. This is what I mean when I say follow the timestamps. The margin announcement came through at approximately 2:15 in the morning, Eastern Time, 2:15 a.m. The Asian markets were partially open. The European markets were still hours away from opening. The U.S. retail trading session was 8 hours away. The only participants awake and capable of reacting at 2:15 in the morning are institutional desks, algorithmic trading systems, the people who already knew it was coming. This is what liquidity cascade looks like in real time. The margin hike triggers forced liquidations. The forced liquidations trigger stop losses. The stop loss triggers cascade into algo-driven selling. The algo selling creates a V-shock, a rapid, violent price drop that then triggers more margin calls in a feedback loop. And the whole thing is orchestrated to happen in the darkest, lowest liquidity window of the trading day so that the price impact is maximized and the recovery is delayed as long as possible. They have done this before. They will try to do it again. But right now, I want to talk about the banking sector. Because the margin hike story is dramatic, but the insolvency story, the real reason the margin hike had to happen, that story, is even darker. In the past week, there has been a wave of viral speculation across financial social media. And I want to address this directly because some of it is rumor and some of it is absolutely grounded in publicly available data, and you need to know which is which. The rumors. Multiple someones failed a significant margin call in the silver market during the initial spike from 60 to 120. The name being whispered is Bank of America. Another name being whispered is a major European dealer institution. I want to be clear. I cannot confirm a specific institution's insolvency. That information is not public. What I can do is walk you through the circumstantial evidence and let you draw your own conclusions. Item 1. The reverse repo market. As of February 10th, usage of the Federal Reserve's reverse repo facility spiked to $26 billion. Now, for context, during normal, healthy market conditions, reverse repo usage is essentially zero or negligible. The reverse repo facility is a mechanism by which money market funds and financial institutions park excess cash overnight at the Fed in exchange for Treasury collateral. When that number spikes suddenly to $26 billion, it means one of two things. Either there is suddenly a massive excess of cash sloshing around looking for safe overnight parking, or, and this is the interpretation I find far more credible given the context, someone needed to access liquidity through an unconventional channel very quickly. $26 billion does not appear in the reverse repo facility on a random Wednesday because everything is fine. That is a distress signal. Item 2. Bank of America published a note. This is a real published research note in which they stated that their fair value estimate for silver was $60 per ounce. $60. This note came out while the price was sitting at $82 and climbing. Bank of America's publicly stated fair value for silver is $60. Now here is where it gets interesting. In that same note, in the same document, Bank of America acknowledged that in a bull case scenario, silver could reach $170 per ounce. Read that again. Their fair value is $60. Their bull case is $170. Why would a bank publish a note saying fair value is $60 when their own bull case is $170? There are only two explanations. Either their research department is incompetent, and these are not incompetent people, or the research note is not analysis, it is price guidance. It is an attempt to use the credibility of institutional research to push down market sentiment, suppress retail buying, and buy time for their short book to be covered. That is not investing. That is market manipulation dressed up in a nice PDF. And I want you to notice something about the way this works. This is the ecosystem of suppression. The CME provides the mechanical lever, the margin hike. The banks provide the narrative cover, the research note. The financial media provides the amplification. Bloomberg runs the Bank of America note. CNBC discusses whether silver is in a bubble. The retail investor sees the drop, reads the bearish research, hears the bubble talk, and sells. The institutional short covers, and the cycle repeats. Except this time, it isn't working. And I'll tell you exactly why it isn't working. I'll tell you in one word. Shanghai. Let me paint you a picture. Let me describe this chart to you in a way that I want you to actually feel. Because if you are looking at the Shanghai Futures Exchange inventory chart for silver, the SHFE inventory, you are looking at one of the most extreme supply destruction events in the history of industrial commodities. This is not a mild decline. This is not a gradual normalization. This is a cliff. At its peak, the Shanghai Futures Exchange was holding roughly 3,000 metric tons of deliverable silver in registered warehouse stocks. 3,000 tons. That is the kind of number that gives banks and industrial buyers comfort. That is a buffer. That is a cushion. That is what allows the paper market to function. Because behind all the futures contracts and the options and the swaps, somewhere there is supposed to be real metal. Today, as of this report, the SHFE inventory stands at 350 metric tons. 350. That is an 88% decline from the peak. 88%. I need you to understand what that means physically. If you took 3,000 metric tons of silver and stacked it, you would have an enormous warehouse, full of metal, real, physical, refined silver. Now, imagine 88% of that warehouse is empty. The lights are on, the security cameras are running, but the shelves are bare. What is left is 350 tons, and it is being consumed by industrial buyers who are desperate for physical delivery because their supply chains depend on it. This is not an investment story anymore. This is an industrial emergency. Solar panels require silver. Electric vehicles require silver. The semiconductor industry requires silver. The advanced electronics that run every single military and civilian system on the planet require silver. And the physical silver that feeds those industries, the stuff that isn't a futures contract, the stuff that is an actual bar sitting in an actual vault in Shanghai, that stuff is almost gone. 350 tons sounds like a big number until you understand what industrial demand looks like. Global industrial silver consumption in 2024 was approximately 650 million ounces. 650 million ounces per year. Divide that by 365 days. You get approximately 1.78 million ounces consumed per day globally. 350 metric tons is roughly 11.2 million ounces. At current global industrial consumption rates, the entire registered SHFE inventory represents approximately 6 days of global industrial demand. 6 days. The vault in Shanghai is 6 days from empty at current consumption rates. And the price is at $84, and people are wondering if it's a bubble. Let me now explain the Shanghai premium, because this is the data point that the paper market cannot explain away. In a normal, functioning market, the spot price, the price for immediate physical delivery, should be roughly equal to or slightly below the futures price. The futures price includes a slight premium called the carry cost, which accounts for storage and financing over time. That is how markets are supposed to work. In Shanghai right now, it is the opposite. The spot price in Shanghai is trading at a premium to the futures price, meaning buyers are willing to pay more for silver right now, delivered today, than they are for silver delivered 3 months from now. That is a condition called backwardation. Backwardation in a physical commodity market is a 5-alarm fire. It means that the physical market is so tight, so stressed, so depleted, that immediate delivery commands a premium over future delivery. The last time we saw severe backwardation in the silver market was during the Reddit-driven squeeze of early 2021. At that point, the SHFE had far more inventory than it does today. The backwardation we are seeing now is occurring against a backdrop of inventory levels that are 88% below peak. This is not the same situation. This is orders of magnitude more extreme. And here is the mathematical divergence that I find absolutely extraordinary. If you price silver based purely on Chinese physical demand dynamics, the backwardation premium, the rate of inventory drawdown, in the industrial consumption data from Beijing, you get a price that is meaningfully higher than $84. The physical reality in Shanghai is screaming a number that is north of $100 per ounce. The paper price in New York is at $84. The spread between paper and physical reality is the widest it has been in modern history. Paper price versus physical reality, write that down, because that spread does not close by the physical price coming down, it closes by the paper price going up. And the only question is, how fast? Now I want to talk about the geopolitical context, because this is the layer that most financial media will not touch. And it is the layer that I would argue is the single most important reason the suppression operation failed so badly last week. We are living through a period of extraordinary geopolitical instability. The US-Iran tensions have reached a level of intensity not seen in years. The Oman back-channel meetings, the quiet diplomatic conversations happening in Muscat, suggest that both sides are acutely aware that a miscalculation could trigger a regional conflict with global commodity. Implications. Iran is a significant oil producer. A conflict involving Iran disrupts the Strait of Hormuz, and anything that disrupts global energy supply creates an immediate flight to hard assets. Gold, silver, the monetary metals. This is not speculative. This is the historical pattern without exception. Every single major geopolitical escalation in the post-Bretton Woods era has resulted in a flight to monetary metals. The 1973 oil embargo, gold and silver surged. The 1979 Iranian Revolution and hostage crisis, silver went to nearly $50. The 2003 Iraq invasion, gold began a decade-long bull market. The 2022 Russia-Ukraine conflict, commodities across the board spiked. The geopolitical bid for silver right now is real. It is not going away. And it is combining with the physical supply crisis in Shanghai to create a demand profile that the paper selling machine simply cannot overwhelm anymore. Let me also address the dollar, because the dollar story is critically important and almost nobody is telling it correctly. The dollar index, the DXY, stalled at 96.6 this week. Now, for those of you who are newer to this, the DXY measures the strength of the US dollar against a basket of major currencies: the euro, the yen, the pound, the Canadian dollar, the Swiss franc, the Swedish krona. When the DXY goes up, it generally creates headwinds for commodity prices because commodities are priced in dollars globally. A stronger dollar makes commodities more expensive for foreign buyers. At 96.6, the DXY has failed to break above a key resistance level. The dollar failed to strengthen. And when the dollar fails to strengthen while a margin-driven liquidation cascade is in progress, when the supposed mechanical downward pressure of forced selling fails to produce even a dollar rally, that is an extraordinary data point. It means the natural safe haven bid for the dollar is being overwhelmed by something else, by distrust in the system itself, by the recognition that the United States government is running deficits that are frankly incompatible with a strong currency over any meaningful time horizon. The dollar stalled. Silver bounced. The trade is clarifying. Let me now take a step back from the immediate data and talk about history, because what is happening right now has happened before. Not in the same precise way, the instruments are different, the scale is different, but the fundamental dynamic is absolutely identical. And understanding that history is, I believe, the only way to properly appreciate the magnitude of what we are witnessing. Go back to 1971, August 15th, 1971. Richard Nixon walks into the White House press room and announces that the United States is suspending the convertibility of the dollar into gold. The Bretton Woods system, the framework under which every major currency in the world was pegged to the dollar, which was in turn pegged to gold at $35 per ounce, that framework died in a Sunday evening press conference. Now, most people who were alive in 1971 did not immediately understand what had happened. The financial media did not scream crisis. The stock market did not immediately collapse. Life looked normal for several months. But what Nixon had done was remove the last formal constraint on government money printing. He had made the dollar, and by extension every major currency in the world, purely a fiat instrument. A promise backed by nothing but the faith and credit of a government that was already running deficit spending to fund the Vietnam War. The consequences took a few years to fully manifest. By 1979, U.S. inflation was running above 13%. Silver went from under $2 per ounce in 1971 to nearly $50 in January of 1980. That is a 2,500% move in 9 years. 2,500%. The people who understood what Nixon had done in 1971, the people who understood that removing the gold constraint meant removing the fiscal discipline constraint, those people positioned themselves in physical metals and watched their purchasing power not just preserved, but multiplied. The people who trusted the system, who believed the Federal Reserve would manage inflation, who kept their savings in dollar-denominated instruments, those people watched their savings evaporate. It took nearly 20 years for the S&P 500 to recover its real, inflation-adjusted value after the 1971 regime change. Now fast forward to today. We are not in 1971. We are in a world where the regime change already happened 54 years ago. We are in a world where the fiat experiment has been running for over half a century. And the accumulated distortions of 54 years of deficit spending, money printing, and financial repression are beginning to manifest in exactly the ways that sound money advocates predicted they would. The U.S. national debt is over $36 trillion. The annual interest payment on that debt has exceeded $1 trillion for the first time in history. The Federal Reserve balance sheet, which was under $1 trillion before the 2008 financial crisis, ballooned to nearly $9 trillion at its peak. The purchasing power of the dollar has declined by approximately 97% since the Federal Reserve was created in 1913. 97%. A dollar in 1913 buys you 3 cents worth of goods today. And yet, somehow, The people at the CME expect you to believe that silver, real, physical, industrial silver, that the entire modern technology economy depends on, is worth $60, is in a bubble at $84, should be pushed down to where the banks can cover their short positions and walk away clean. No. The history says no, the Shanghai inventory says no, the backwardation in the spot market says no, the geopolitical environment says no, the dollar stalling at 96 says no, and the price recovery from 64 to 84 says no louder than all of them combined. Now, let me talk about 2008, because I know some of you are thinking, but in 2008, everything crashed. Gold crashed, silver crashed. How is this time different? And it is a fair question, and the answer matters. In September of 2008, when Lehman Brothers filed for bankruptcy and the global financial system went into acute crisis, silver dropped from approximately $20 to around $8 in a matter of weeks, a 60% decline. Gold also fell sharply from around $1,000 to below $700. Everything liquidated: stocks, commodities, emerging market currencies, everything sold because everyone needed dollars to meet margin calls and redemptions simultaneously. But here is what happened next. Silver went from $8 in late 2008 to $49 in April of 2011. That is a 500% move in under 3 years. The crash was a buying opportunity of generational proportions. And the people who understood the fundamental thesis that the policy response to the crisis would be massive money printing, that the Fed would go to zero rates and beyond, that the bailouts would create moral hazard and systemic weakness, those people bought silver at $8 and rode it to $49. The people who sold at $8 because they were scared because Bloomberg said the commodity bubble was over, because CNBC said the safe haven trade was dead, those people missed one of the greatest commodity moves in modern history. What is happening right now rhymes with 2008, but with a critical difference. In 2008, the silver market was predominantly a financial asset, a speculative vehicle. The industrial demand picture was significant but not dominant. Today, the industrial demand for silver has been transformed by the energy transition. Solar photovoltaic installations have consumed silver at an extraordinary rate. The amount of silver required per unit of solar capacity has declined with technological improvements. But the absolute volume of solar deployment has exploded so dramatically that total solar silver demand is now measured in hundreds of millions of ounces per year globally. This is not speculation. This is not the Goldbug thesis about monetary metals being undervalued relative to money supply growth. This is, the entire global green energy agenda runs on silver, and we are running out of the above-ground stock. That is a fundamentally different thesis than 2008. And it is why the price recovery from 64 to 84 happened in days rather than years. Let me now address something that I think is critically important, and it's something that the mainstream financial media absolutely refuses to discuss: the concept of rehypothecation. And specifically, the way that rehypothecation in the silver market creates a systematic fragility that makes events like last week not just possible, but inevitable. Rehypothecation is the practice of using collateral pledged by one client as collateral for another transaction. In the silver market, this means that a single ounce of physical silver can be used as backing for multiple paper claims simultaneously. The bar that is sitting in a vault in London in the LBMA system, that bar has potentially been pledged as collateral for not one, not two, but potentially dozens of separate paper-silver transactions. This works fine as long as nobody asks for delivery. The whole system functions smoothly as long as the paper promises circulate and the physical metal just sits there. But when people start demanding physical delivery, when the industrial buyers in Shanghai show up at the vault and say, we need the actual metal, not a contract, not a paper claim, the actual refined silver, the rehypothecation pyramid begins to fracture. Here's a number I want you to sit with. The ratio of paper silver claims to physical silver available for delivery on the COMEX has at various points in recent history exceeded 300 to 1. 300 paper claims for every physical ounce available. That ratio has fluctuated, and the exact current figure is contested, but the direction of travel is clear. More paper, less physical. More promises, less metal. When the SHFE inventory collapses 88% and Shanghai goes into backwardation, it is because the industrial buyers have discovered what the paper market already knew but refused to admit: there is not enough physical silver to back all the paper. And so they are demanding delivery before it runs out entirely, and every ton they pull out of the vault is 1 ton less to back the paper claims that remain. This is a slow-motion run on the silver bank. And the CME margin hike last week was the equivalent of a bank closing its doors temporarily to prevent a bank run. They raised the margin. The forced liquidations happened. The price dropped. The banks caught a brief moment of relief. They used that relief to cover some shorts, reduce some exposure, and then the physical demand came roaring back. The price recovered, and here we are at 84. They bought themselves maybe a week, maybe 2 weeks. They did not solve the problem. The problem, the fundamental imbalance between paper claims and physical reality, is still exactly as extreme as it was before the margin hike. Possibly more extreme, because the Shanghai drawdown continued during the price suppression event. Here is where I want to get very specific about what the banks are facing. Let me walk you through the short position math. The commercial banks, the category the CFTC reports as commercial, in its commitment of traders' data, have historically held a net short position in silver futures that represents billions of ounces of paper. Silver. Not physical silver they own, paper silver they have sold short, meaning they have promised to deliver silver at a future date at current prices. When the price goes up, that short position loses money. When the price goes up from, say, $30 to $84, when the price nearly triples, the mark-to-market loss on those short positions is catastrophic. Let me give you a rough calculation. If the net commercial short position is approximately 1 billion ounces of paper or silver, and historical data from CFTC reports suggest this order of magnitude is reasonable, then a $50 move in the price of silver represents a mark-to-market loss of approximately $50 billion on that short position. $50 billion. That is not a rounding error. That is not a manageable loss. That is an existential threat to the financial institutions carrying those positions. And here's the brutal irony. The same institutions carrying those short positions are regulated by the Federal Reserve. The Fed is supposed to be ensuring systemic stability. The Fed knows these positions exist. The Fed knows the losses are mounting. And the Fed's response, the spike in reverse repo usage, the quiet liquidity support, is to help those institutions survive long enough to figure out an exit. In other words, your central bank is using monetary policy tools to help the banks that manipulated the silver price survive the consequences of their manipulation. This is the circular logic of the captured regulatory state. The regulator protects the regulated, the exchange protects the members who pay its fees, the central bank protects the banks that own it. And the retail investor, the industrial buyer, the country that needs silver for its solar panels, all of them pay the price. Except now, the physics of supply and demand are overriding the mechanics of the system. 350 tons in Shanghai, backwardation, geopolitical tension, dollar failure, $675 million of forced liquidations that couldn't keep the price below $80 for more than a few days. The system is failing in real time. Now, let me talk about what comes next, because I think this is the most important part of this entire video. And I want you to hear this carefully, because I have been watching these markets for a long time, and what I am about to describe is not speculation. It is the logical next step given every piece of data we have discussed. The banks fired their biggest weapon, a $675 million margin extraction event, an overnight rule change designed to trigger a liquidity cascade. A coordinated research note from one of the largest banks in the world saying fair value is $60. And after all of that, after deploying every tool in the suppression toolkit, they could not keep silver below $80 for more than a few days. When the primary weapon fails, you move to the secondary weapons. The secondary weapons are exchange rule changes, not margin hikes, those were primary, I mean structural rule changes, position limits, delivery rule modifications, cash settlement clauses, the ability for an exchange to force settle a contract in cash rather than requiring physical delivery. If the COMEX were to implement cash settlement for silver futures contracts, if it were to say unilaterally that contracts will be settled in dollars rather than in physical silver, that would be the moment that the paper price and the physical price formally and permanently decouple. The COMEX price would become irrelevant to anyone who needed actual silver. The physical price, the price you pay for a 1-ounce coin or a 1,000-ounce bar from a dealer, would move independently of the exchange price. We have seen this happen before. The London Metal Exchange suspended nickel trading for over a week in March of 2022 after a short squeeze drove the price above $100,000 per ton, a 250% move in 2 days. The LME subsequently canceled trades that had already been executed. They retroactively unwound billions of dollars in legitimate profits made by traders who had been long. They gave those profits back to the short sellers. This is not ancient history. This happened 3 years ago. It can happen in silver. The machinery is there. The precedent exists. And if it does happen, if the COMEX announces cash settlement or suspends trading or retroactively cancels trades, then holding physical silver, not a futures contract, not an ETF, not a mining stock, but actual physical silver in your hand becomes the only position that cannot be taken from you by a rule change. I want to say something directly to the people who have been stacking physical silver. The people who looked at the paper games and decided, years ago, that they would rather hold the real thing. The people who paid the premium over spot price to buy the actual bars and coins. You made the right call. The thesis was correct. And everything that has happened in the past week, the margin hike, the forced liquidations, the Bank of America note, the Shanghai collapse, all of it validates exactly what you understood when you decided that paper promises are not assets. Physical silver is not a trade. It is not a bet. It is the ultimate opt-out from a system that has been systematically transferring wealth from people who hold real things to people who print paper claims on real things. And the transfer mechanism is breaking down in front of our eyes. For the people who are not yet positioned, the people who watched the crash to 64 last week and thought about buying but didn't because they were scared, let me tell you what the data says. The SHFE has 350 tons of silver left. The global industrial demand for silver is running at levels that the known mine supply cannot meet. The silver market has been in a structural supply deficit, meaning consumption exceeds mine production plus recycling for 4 consecutive years. 4 years in a row, the world has consumed more silver than it has produced. The deficit is being met by drawing down above-ground inventories. And we just watched 88% of the Shanghai inventory disappear. This is not a favorable entry point. This is potentially one of the last opportunities to accumulate silver at a price that is still being influenced by the paper market. Once the paper market loses its ability to dictate price, and based on last week's failure, that moment is closer than most people think. The physical price will find its own level based purely on supply and demand dynamics. And the supply and demand dynamics say much higher. The Bank of America fair value of $60 is a fantasy. It is a number produced to serve a book position, not to describe reality. Reality is $84 and climbing. Reality is 350 tons in Shanghai. Reality is backwardation. Reality is a margin hike that failed. Let me give you the numbers you need to anchor the thesis, because I want you to be able to defend this position when someone at work says you're crazy for buying silver at $84. Number 1, the gold to silver ratio. Historically, the average gold to silver ratio over the past 100 years has been approximately 47 to 1, meaning 1 ounce of gold historically purchased 47 ounces of silver. As of today, with gold at approximately $2,900 per ounce and silver at $84, the current gold to silver ratio is approximately 34 to 1. 34, still below the historical average. If the ratio simply reverts to its long-run mean of 47, not an extreme scenario, just a reversion to average, and gold holds at $2,900, the implied silver price is $62, already below current market. But if gold continues its bull market run, if gold goes to 4,000, 5,000, as many analysts now project, then at a 47 to 1 ratio, silver would be $85 to $106. And if silver catches a scarcity bid on top of the ratio reversion, the numbers get significantly larger. Number 2, the production cost. The all-in sustaining cost for primary silver miners, the cost to pull 1 ounce of silver out of the ground, process it, and bring it to market, is approximately $23 to $28 per ounce for the most efficient producers. For the industry average, it is closer to $32 to $35. But that does not tell the whole story, because the majority of silver, approximately 70% of global mine supply, comes as a byproduct of copper, lead, zinc, and gold mining. That byproduct silver does not have a standalone production cost. It depends entirely on the economics of the primary metal. When copper prices fluctuate, when zinc mines face reduced investment, when the primary metals that drive byproduct silver production are under pressure, the byproduct silver stream shrinks. You cannot simply ramp up silver production by drilling more silver mines, because most silver is not produced in silver mines. Number 3, the solar demand trajectory. The International Energy Agency projects that global solar photovoltaic capacity will need to reach roughly 8,000 gigawatts by 2030 to meet the Paris Agreement targets. Current installed capacity is roughly 1,500 gigawatts. To go from 1,500 to 8,000 gigawatts by 2030 requires deploying more than 900 gigawatts per year. Each gigawatt of solar capacity requires approximately 70 metric tons of silver. 900 gigawatts per year times 70 metric tons is 63,000 metric tons of silver per year for solar alone. Global silver mine production is approximately 26,000 metric tons per year. The solar demand alone exceeds total global mine production by a factor of 2.4. Now, the silver content per panel continues to decline as manufacturers thicken certain components and thin others. But even with continued efficiency improvements, the trajectory is unmistakable. Global green energy policy has set us on a path towards silver demand that is structurally incompatible with current supply. This is not the gold bug thesis. This is not monetary theory. This is solar panels and electric vehicles and advanced semiconductors cannot exist without silver, and we are not mining enough of it. So when Bank of America tells you fair value is $60, ask them to reconcile that number with 63,000 metric tons of annual solar demand against 26,000 metric tons of annual mine production. Ask them to reconcile $60 fair value with 350 tons left in Shanghai. Ask them to reconcile $60 fair value with 4 consecutive years of supply deficits. You will not get an answer, because there is no answer that is consistent with their stated fair value estimate. The number is not analysis. It is propaganda in service of a short position. I want to spend the last few minutes of this video talking about what you should actually do, because I know that is why you are here, and I am going to be direct. If you are already holding physical silver, do not panic. Do not let last week's drop shake you out of your position. The margin hike was designed to shake you out. That was the entire point. The psychological warfare component of a margin-driven liquidation cascade is that it creates fear and doubt among the very people who understand the thesis best. It is designed to make you question yourself. Do not. The data has not changed. The Shanghai inventory has not refilled. The supply deficit has not reversed. The geopolitical environment has not stabilized. The dollar has not found a new source of fiscal discipline. Nothing about the fundamental thesis has changed. The price went from 120 to 64 and came back to 84. The trap was set. The trap failed. If you are not yet positioned, if you have been watching this market and waiting for the right time, understand this. The manipulation events are the buying events. When the CME hikes margins and forces liquidations, when the price artificially drops below the level that fundamental analysis supports, when the paper selling machine temporarily overwhelms the physical scarcity signal that is the gift. Last week was a gift. The question is whether you saw it in real time or whether you are reading this after the price has already recovered. If you missed it, do not chase. But also do not wait for another $64 print. That may have been the last one. The physical market in Shanghai cannot sustain much more drawdown before delivery failures begin. And once we have the first publicly disclosed delivery failure on a major exchange, once a buyer who holds a futures contract demanding physical delivery is told, for the first time, that the metal is not there, the dynamic changes permanently and instantly. That is the moment when every financial institution on the planet that has been complacent about silver exposure suddenly needs to recalibrate. And that recalibration, that simultaneous demand for physical silver from institutions that have spent years assuming it would always be available, is what the word unobtainium was invented to describe. When industrial silver becomes genuinely scarce, when the word allocation starts appearing in dealer communications, when the premium over spot for immediate physical delivery starts expanding, not by 10 or 20%, but by 50, 100%, that is when the price discovery process truly begins. And the price it discovers will be a number that Bank of America's research department will not be able to explain with a straight face. Follow the money, not the paper money, not the fiat digits in a brokerage account. Follow the metal, follow the physical reality, follow the Shanghai inventory chart falling off a cliff. Follow the industrial buyers who are in backwardation because they need silver more than they need a favorable futures price. Follow the institutional accumulation that started the moment the forced selling from the margin hike was complete. The panic selling is over. I said that at the beginning, and I am saying it again at the end. The panic selling is over. The institutional accumulation has begun. February 11th, 2026. Silver at $84. The CME tried to kill this market and failed. The banks used their research notes as weapons and failed. The reverse repo spike tells you someone needed emergency liquidity. The SHFE inventory tells you the physical market is at a breaking point. The geopolitical backdrop tells you the safe haven demand is structural. And the price itself tells you the market has already rendered its verdict on the suppression attempt. They fired their biggest weapon. They missed. Do not let them steal your position. Follow the money.